Jeez, it's been a while, Sam, hasn't it?
It's been a long time.
Merry Christmas, Happy New Year.
Yeah, and to you and to everyone watching. In the immortal words of Michael Jordan, I'm back. And Tim's back as well. We're back. So
we're back. We're back in action. So we've had a lot of people away on holidays through Christmas the January period. We've got the full staff back now, so we're back in action doing podcasts and the rest of it.
Yep.
So a lot's happened since we spoke last.
So there's been a bit of a pause. So if you've missed our episodes, we're sorry about that. Know that we would have said some insightful and useful stuff, and it's a bit of a shame you weren't there to hear it, but I'm sure we'll repeat some interesting information this session.
Absolutely. All right. So today I think we're talking a bit more about current events, and a bit's changed actually since we came back after the new year, hasn't it?
Certainly has.
The sentiment related has changed a lot.
Yeah, absolutely. I think the narrative in global markets has really gone from, extreme recession in middle of 2023 now to people being, maybe things aren't quite as bad or won't be as bad as we first thought. You just had US fourth quarter GDP come out last night, and that was a really positive surprise, much better than expected. Whereas, some of the pricing indicators from that reading weren't actually that strong. So I think a positive sign for the inflation, interest rate and growth balancing act.
Yeah, well, definitely at the moment, when you're looking at all the economic data, it's starting to pile up towards more of a soft landing, isn't it, right?
Yep.
So, we had really good job numbers out of the US. We've had a tame CPI, so we're seeing CPI come back off a bit. Strong GDP in the US, a bit better than expected. There's probably a few I haven't thought about, but every piece of data that I've looked at since early Jan is suggesting to me that the US is going for more of a soft landing rather than that hard landing we were all worried about last year.
Absolutely. And then I think, the other big event in US markets at the moment is also sort of pointing to that, and that's the earnings season.
Yeah.
And so far, we'll wait for the Oracle of Earnings, Howard Silverblatt, to put out a spreadsheet, but so far, it's looking quite positive. And even on the forward guidance, perhaps not quite as negative as a lot of people are expecting.
Yeah, well, you got to expect a bit of a pullback in forward guidance, but it hasn't been too bad, has it?
No.
It's pretty good. Even if having a sideways period of earnings here with how far some of these growth stocks have sold off, even for me, for the next 2 years, if earnings go sideways, that's still a buy for that space for me.
Yep.
Because I just don't want to see a decline.
Yeah.
If they can hold earnings through a period where high inflation and higher labour costs, all that sort of stuff, and higher interest rates, I think they're doing well.
Absolutely. And as you're sort of alluding to, it has been, 2022, I should say, was a period of strong selling in these growth stocks, strong selling in these tech stocks. And now, the last couple of weeks, last week and a half, that sell down is perhaps, at least looking at the chart, coming to an end.
So looking at that NASDAQ chart, at the moment, we obviously don't have it up on the screen, but go have a look at it yourself, guys. I think that's an important chart to be looking at. What we've seen is a period of a big channel along the base there, about probably 4 or 5 touch points along the support. I'm going off memory here, guys.
We'll edit it in.
Yeah, edit it in. We'll bring it in, right? And then we've got a break of the downtrend. NASDAQ's back to the 200-day moving average and right at a key resistance. If that resistance breaks, then that is a reversal pattern.
Yep.
Okay. And that means that we've got a new formed uptrend, and there's lazy opportunity for the next year or so.
Absolutely. I think at this point we're waiting to see whether it's a shallowing of the trend perhaps, or actually a change in the 12-month downtrend that tech stocks have seen.
Yep. So technically we need that breakout to the upside, the good proper breakout, and if we get that, to me, I'm on.
Yep, absolutely. And then, you look at our own market and, what 2022 sell down. It's pretty much back to the all-time high within, 2%. So within striking distance. And, if you were watching our webcasts all throughout last year, we were saying, value stocks, material stocks, commodity stocks, that's where you want it to be. And, if you'd listened to our advice, hate to blow our own trumpet, but you would do quite well at the moment. You wouldn't have experienced such a negative 2022.
Yeah. Look, I'm going to have to argue for a pretty bullish 2023 here if China actually comes out full force stimulating and trying to boost their economy back up. They've got low GDP and they've got low inflation. So they can do what the Western nations have done coming out of COVID and stimulate. And let's just see whether they can keep opening that door. And if they do, that's definitely a bullish reason. Or a reason to be bullish our market.
Absolutely. I think, if that's the case, and also going into an environment where people see interest rates peaking, you're probably going to want to look at, like the growth commodity stocks for our market. Perhaps the future metal stocks, the lithium stocks. If China really stimulates, we would expect continued strong commodities demand. And if interest rates peak, we'd expect, growth stocks to do well. Yep. So some blend of that in our own market could do quite well. I don't disagree with that at all. China's one of the uncertain factors. And then I also think how consumers respond to the interest rate rises. Yeah. Our market's been quite insulated from that with the fixed rates. How things play out in the middle of this year when everyone's rates go to a variable rate, I think that'll influence our market as well.
Well, considering this week's CPI reading locally, I really do hope people feel a little bit of this pain and stop spending so much, guys. We need to chill out a bit. We need that inflation down. Like if we don't start seeing that go down, then that's going to force central banks to lift interest rates harder. And that's that's the flip side of all this, isn't it? Right?
Yeah,
so
absolutely.
if we're going to debate both sides of the coin here for a second and go, okay, well, there's definitely some things to get excited about here, right? You got China reopening, you got a potential move back into the growth in the US with the interest rates topping out in the US, inflation topping out in the US. All of that seems very, very positive right now. But what if? What if in another 2 or 3 months we see the opposite happen? As strength comes back in, inflation goes up, then central banks have to flip again.
Absolutely. And I think that's a very good point. A lot of this recovery has built around the fact that people think rates will top out in a few months, they'll stabilize and then they'll come back down. But unless, inflation and CPI comes down, that's not going to be the case.
Yep.
So US CPI has started to come down, and I think that's given a lot of people enthusiasm. But as you said, our own CPI was much higher than expected. It's not coming down. And our Reserve Bank, our RBA, has been a little bit slower on the rate rises because up until now, they've been able to say our CPI isn't as bad. We don't think it's going to get quite as bad. Yep. And now, will they be able to maintain that, or will they be forced to push rates further?
Correct. And there's just so much at play worldwide on this inflation front. Like, what does China's demand mean for inflation this year? Can the supply chain open up quick enough to take care of that China demand? It's the biggest economy of the world reopening out of COVID, taking down all their travel restrictions. All of that's happening, guys. So what does that actually mean for inflation?
Yeah, exactly. So again, another balancing act between their supply coming back online and their demand coming back online. And prices are the balance between supply and demand. So I don't think anyone rightly knows which of those two factors will win. Yes, there's a lot to weigh up at the moment. But when things are a bit like this, there's a lot of opportunity as well. And you were saying, the NASDAQ might be breaking a 12-month downtrend. If you get that call right, if you go long there, for example, and it does break that downtrend, that's a huge opportunity for outperformance.
I know I'm just getting ready, right? So I know my strategy. Okay, I'm looking at a growth ETF in the US and then looking to write call options on top of that. That's my strategy. I haven't executed yet, just purely waiting for that break out to the upside. You got the Fed next week as well, right? So I'm in the mindset of, okay, well, we're halfway through the earnings season. Let's see how that wraps up. Yep. Let's see what the Fed says next week, and then kind of start looking at entry signals from there, confirmations and things like that.
Absolutely. So you will get the Fed interest rate decision on the 1st of February. Likely to be another 25 basis point rate lift. So it'll likely come down. The market response will come down to what they say.
They have to stay somewhat hawkish, don't they?
They do, yeah. I think, growth is maintaining, unemployment staying low. I don't think there's been enough pressure to ease up on it. Yes, CPI is coming down, but it's still well above the target range. So I think they'll keep their foot on the pedal or on the brakes is probably a better word.
Better word, brakes, that's right. It's going to be this balancing act for them this year politically, because they can't come out and become neutral or dovish until that inflation reading comes down. But also they're trying to get a soft landing, so they can't keep just bumping rates up. So they're going to have to go sort of hold on rates at some point, which they're suggesting after March. And then they're going to have to continue to communicate in a hawkish manner to keep people sort of on that side of being a bit more conservative and not going out there and spending too much money.
Yeah, it's going to be a very difficult task, I think, the balancing act they have to play this year. And I think they have to preempt the economic downturn rather than responding to the economic downturn. So, if things really start to downturn and that's when they start reducing rates, I think it'll be too late at that point. I think they've got to stop well before that.
The way this GDP data and jobs data comes in, mate, I think we're going to be waiting a while.
We might be waiting a while. But then, that's another question for markets, because the markets are expecting rates to peak soon. So...
and let's just see, right? If at any point that expectation changes, so if you look at the FedWatch tools out there and that, they're all suggesting that rates are going to peak in March, stay on hold until about September, and then start slowly, maybe potentially coming down. If that changes to, we're going to keep lifting rates until July, well, watch this market fall, right?
Yep.
That's your worst case scenario, right? Well, one of the worst case scenarios right now.
Yeah, absolutely. So I mean, it's all very interesting at the moment. We're at a key point, and I think, like we were saying, big opportunities can come at times like this, when the market is less volatile and not doing too much and just grinding slowly higher or grinding slowly lower. There's really not as much opportunity, but at the moment, huge opportunity. And the other thing is rates eventually lead to higher returns. So, we're seeing that in things like the hybrid space at the moment.
Yeah.
You can get, north of a 6% yield on, major Australian bank hybrids. And that's something we're doing a lot of work on at the moment, just because they are so attractive. There are such high yields at the moment, attractive prices there.
For sure, and this is what brings me back to what I think is going to happen in the equity markets in general, right? Like, coming out of COVID, we saw this massive V-shaped recovery in the US market, doubled itself, didn't it? Over the 2 years after COVID. Yep. Because you didn't want to really invest in the bond space, did you?
No.
Right? We knew interest rates were at going towards all-time lows. There's only one way for them to go from there, and that was back up. And you don't really want to be investing heavily in that space when yields are climbing.
No,
right?
No.
But when yields have climbed and looking toppy, that's the time to be in that hybrid bond space. So now you've got a share of funds. Like, funds are moving towards bonds and equities.
Yep.
So equities won't go up as fast as they did after COVID, guys. So just don't have that expectation, right? It'll be back up the staircase. Last time that wasn't a staircase, guys. That was just a rocket ship, wasn't it?
Yeah,
right?
Rocket ship, yeah.
We saw the rocket ship emojis pop up everywhere, right? We had all the young people jumping in the muck. This time it's not going to be that way. No. Not until interest rates start coming back down again, I feel. Would be then a rush of blood to the equity. But I think a slow climb from here in the US growth space is definitely on the table.
Yeah.
Not this massive launch that we saw last time.
Absolutely. And, there's some great stocks there at now relatively good prices.
Yep. If you're buying long term, it kind of makes sense, but just be wary of if inflation starts going up.
Yep. Absolutely. I think that's probably
wraps up my thoughts right now.
Yeah, mine as well. And hopefully you guys enjoyed that. Hopefully, you got something out of it. Perhaps you've got a question or, a comment you want to make. And if you do, let us know down below in the chat box.
Chat about it in a couple of weeks' time when we catch up again.
Yeah, absolutely. Always love some participation. Give us a like and a subscribe. That really helps us out. And
awesome.
See you in the next one.
Thanks, Sam. Thanks, everyone. Take care.
Bye for now.